Hello, everyone, and welcome to the Inside ETFs weekly webinar, The Continuous Rise of the Price War, Thriving in a World of Zero. My name is John Swolfs, and I'm the Vice President and Head of the EMEA business here at Inside ETFs, and I'll be your host for today's webinar. With over 137 ETFs now offering an annual expense ratio of 10 basis points or less, and with more to join, it's easy for investors to make money, but harder for asset managers to attract investors' money and gain market share. We're joined today by two leading advisors for a hard-hitting conversation on how this industry can survive in a world of low fees as this price war continues. First joining me is Michael Jones. He's the chairman and CEO of Riverfront Investment Group. His primary investment responsibilities are setting the firm's overall asset allocation strategy and ensuring appropriate investment and risk management processes are applied to all the firm's portfolio decisions. Previously, Michael was the CIO at Wachovia Securities, and he has a BA in economics from the College of William and Mary and an MBA from the Wharton School. Joining Michael will be Bob Smith, and he co-founded Sage in 1996 with Mark McQueen and serves as the firm's president and CIO. In that role, he leads its investment committee. He began his career at Moody's Investor Services as a member of the Corporate Bond Rating Committee. He then went on to Loeb Rhodes & Co. and on to cover the insurance industry and an institutional equity research department. Bob later worked at Merrill Lynch in a variety of institutional research, trading, and portfolio management roles. And he's in New York and London. Oh, very nice, Bob. He received his MBA in finance from New York University School of Business, the Stern School of Business, apologize. But before we jump into things with Michael and Bob, I wanted to start with Monik Dillon, president of Victory Shares, where he at Victory Shares is in charge of their product solutions. In his role, he leads and oversees the firm's exchange-traded and solutions business. He is also responsible for setting the strategy and initiating the development and implementation of Victory's strategic beta-based offerings. Additionally, he manages the solutions provided by our investment franchises, which include enhancements, extensions, and innovations designed to best meet the needs of clients. Mr. Dillon also contributes to the evaluation capabilities of potential new franchises as part of the firm's acquisition strategy. We will bring him in just a moment to go ahead and get started, but I did want to welcome all of our speakers today. But let's go ahead and get started with Manik. Manik, how do volatility-weighted ETFs work?
Well, thank you for having me today. We, first of all, believe one of the limitations of cap-weighted indices is that it creates a false sense of diversification for clients. So we wanted to come to market with a solution to help them address that issue. And we prefer a volatility-weighted approach because we think it helps them diversify the risk and the exposures that the concentration in cap-weighted products create just by the nature of how they're created. And the way we achieve that is basically by inversely weighting securities based on their risk, which means that risk is spread evenly across all of the constituents in the index and therefore the product based on their historical standard deviation. It creates a better diversified index in our opinion, and that is the end goal of that product.
Absolutely, just a different way to go about building an index. So certainly understand the approach there. But when you look at that, it is certainly different than traditional approaches. But how do they compare to the traditional min volatility ETFs?
So they are different. I guess one commonality is they have the word volatility in them, and that's probably where I would consider the stops. So minimum volatility and low volatility products are designed to deliver to the client a particular exposure, and that exposure is to an end portfolio that is either has low standard deviation, low volatility, or is exposed to low volatility stocks, and that's a specific factor that they're trying to get exposure to. We, on the other hand, have ETFs such as CFA, which track these volatility-weighted indices whose objective is diversification. That's the big difference, is the objective is not to expose the client to low vol as a phenomenon or factor, but to drive diversification by inversely weighting companies based on their risk. And that's what makes them very different. So in our approach, volatility becomes a weighting mechanism. In those approaches, it's really a selection tool.
Oh, okay, so that's a big difference there when one is kind of more of a selection tool and one's a little bit differently focused there. What I want to know, though, is because typically you see that a lot of ETFs are not cash shaped, but you have a long cash ETF. So one, how does that work? And then how does it avoid getting whipsawed by the market?
Well, we think there are a couple of different challenges that investors do face, right? So one is when bull markets start to get long in the tooth, so to speak, and with an aging bull market like we have today, we think investors are best served by being able to toggle their equity exposure in an objective way. And so one of the solutions that this type of long cash approach provides is to solve for just the behavioral issues and the challenges with exiting the market exposure when there is a downturn and then reinvesting as it comes back up. So we have a suite of enhanced ETFs that offer this objective way to automatically toggle the investor's exposure either in securities or into cash or cash equivalents. And it eliminates that emotional decision-making that can often derail us as investors in a protracted market downturn, right? Like the ones you have in 2008 and so forth, where a lot of investors out there waited until the depths of the market to exit, and then some of them haven't even gotten back in now.
Yeah, absolutely. So, and this is kind of off script a little bit here, but I just wanted to follow up with it. So does the ETF help keep investors in the market because it toggles between the securities and cash?
It does. So one of the benefits, potential benefits it has is if the market's not in this significant downtrend or down market period, it'll be fully invested, right? So you have the opportunity to have exposure to the markets like we have in the last few years that have just been trending up. Now, if that trend reverts, and the way the methodology works is it only makes that determination at every month end. That's what helps limit it from being whipsawed. You don't want to create a methodology like this that might react too often. And so then it will help the client's exposure to the market go down to basically liquidating 75% of the portfolio so that they have 25% exposure to the market. Then as the market trend gets worse, as that downturn gets worse, it will systematically reinvest up to a point where it will eventually become 100% invested if things get worse enough.
Absolutely, makes a lot of sense. So with that, one might draw the conclusion that you guys think that there's an index bubble. So one, do you think there is an index bubble, and should investors be worried about cap-weighted ETFs?
Well, I don't think that there's an index bubble per se. I do think that certain indices promote bubbles, though. And that's specific to your question about cap weighting, that if you have a design that simply allocates more to companies as they get bigger, once that trend stops, it does have the opportunity, have the potential of ending badly from a risk-return perspective, because that generally ends up in high levels of concentration that clients and investors don't anticipate. For example, where today you have one sector like technology close to 25% of the index. The top 10 largest stocks making up roughly 20% of the index. That is not the diversification I think that investors sought out when they say I want to invest in an index. And that in our opinion is where certain approaches like cap weighting can create those bubbles.
Absolutely. So we have time for one last question for you, and I want to go ahead and fire off a good one. And it's a little bit more of a general theme, though, here. But what's next for Victory Shares? If you have creative and innovative ETFs like you just described, what are you guys working on next?
Well, in general, we're going to just keep continuing to do what we've done, which is help clients bridge that gap between their traditional passive portions of their portfolio and the traditional active portion of the portfolio. We think there's a tremendous void in the tools available, and our approaches like volatility weighted, our multi-factor minimum volatility, and our dividend accelerator products can help them do that. And really around our flagship offerings like CFA and CFO and CDC, educating clients on how those tools fit into their portfolio, because we think that that's actually an area where ETF issuers such as ourselves can do a lot of good work, because it's easy to roll out products it doesn't really matter if we can't help people figure out how to use all these new tools that are available to them. So we're going to be spending a lot of time on education of our clients and working with them there.
Well, that's great to hear. Certainly, always know that advisors can benefit from education. It certainly helps their end client as well. The more they know, the better invested they are. So do appreciate you taking the time to join us here on our webinar and keep our audience educated. So best of luck with everything in 2018. But why don't we go from here, boys, and move into the bigger conversation about the fee war going on within the asset management industry. But again, thank you to Manik for joining us. But let's go ahead and bring Bob and Michael back on. Bob and Michael, how are you guys today?
Just great.
Doing fine.
Good to hear. And I know, Michael, you're a little bit under the weather, so we'll take it easy on you today. But Bob, I wanted to throw the first question out there to you. And today's topic, right, it centers on this idea of a fee world, and we see that ETFs continue to lower their expense ratio. Big picture, what does this mean for you and your business as fees continue to get compressed?
Well, it just makes it much more difficult. Obviously, performance is one of the biggest ingredients driving this, and once again, active management, particularly in the equity sector, continues to underwhelm in terms of the average performance. The U.S. Diversified Stock Mutual Fund average performance, according to Lipper and Morningstar, came somewhere in the area of about 18.2% for the past year, with the S&P at 21.8, the Dow at 25, and the NASDAQ at close to 30 at 29.6. With that realm of underperformance, there's only one thing that providers are going to be able to do, and that is cut fees in order to hold ground. That is now filtering on through the whole complex. Sadly, on the fixed income side, 85% of the managers in the core intermediate fixed income arena actually beat their indexes, but they also are suffering at fees. So in terms of fee reduction. So when you look at the reductions that have gone on, two things, passive is better than active. So active equity managers continue to give active management a bad name. Active sector rotation, active tactical ETF allocation, all of those things are worthy, but the stock pickers, quite frankly, are kind of mucking up the water for the rest of us and helping to cause that fee reduction to come down. Technology also has helped that in terms of how much more can I compress to the value of the investor by delivering my services more efficiently, whether it's on a digital basis in terms of communications, whether I'm employing AI capabilities in terms of just executing trades and so forth. But what has this led to? You look at the average fee complex in terms of active managers and look at all the funds. 3 years ago, we were at 80 basis points. At the end of 2016, we were at 75. But you put that up against ETFs and index funds. 3 years ago, you were at 21 basis points. Today, at the end of 2016, going into 17, you were at 17 basis points. You look at those differentials, and you know what? I'm heading towards passive product, and that is continuing to happen, and this is what's helping to drive the process. It's a reinforcing mechanism, and when you look at that in terms of just U.S. equities, at the end of 2016, the average passive product in U.S. equities was 11 basis points. The average fee for an active U.S. equity manager, 77 basis points. That's a no-brainer. And when you look at the underperformance that continues to go on in terms of active stock selection, it just makes it a self-fulfilling prophecy that I've got to continue to put money to work in the passive arena. Now, tactical ETF manager, you can grab that and you can take that and make an advantage out of that. And I think that's kind of the way to go here in terms of, low cost, but active management and actively managing the big decisions, not the small little decisions such as stock selection.
Well, Bob, with that, I want to go ahead and bring Michael in to get his thoughts on it. And then I actually have a follow-up question for both of you guys on that. But Michael, how is this kind of race to zero impacting what you guys are doing over there at Riverfront?
Well, I think it's important to recognize where the race to zero is. As Bob alluded to, if you are a manager that does what I would call, consensus asset management, if you have an asset allocation that's largely static, your return assumptions don't change very much, you use passive market cap weighted portfolios to implement that strategy, the price of that portfolio is rapidly going to zero. And if you're competing in that, you better be able to out BlackRock, and out Vanguard, which I don't think you can do. Our approach is to sort of combine a couple of the threads from Bob's comments, where the first thing is to have a definitive value add proposition for your asset allocation. And when I say a definitive value add proposition, I don't mean tell them how your mean variance optimization process is an improvement on blah, blah, blah. That's not going to resonate with your client base. It's an underlying methodology and an underlying philosophy that they can believe in and that they can believe will be a great long-term solution for their portfolios. So first is a value-added proposition on asset allocation. And then second, we believe that passive and active are not at war with one another. They are essentially complements to one another. And what I mean by that is, Morningstar did a fantastic study of the last 30 years in asset management. And what you saw is that there was one period of time when passive always outperforms by a couple of hundred basis points. And that's when the market's been going up 15, 16, 17% per annum for 3 straight years. In that kind of red hot market, the momentum factors that is inherent within a market cap weighted index, it's really hard to stay up with that. On the other hand, as returns drop, active managers come to the fore. And I honestly believe that we are transitioning out of this, go-go double-digit return environment. We're no longer valued for that. We've gotten an awful lot of great earnings information and great global growth, but in the U.S., we're kind of priced for that. So we think that returns are not going to be 15, 16, 17%. They're probably more likely to be 8, 9, 10. And that's the kind of environment where active management comes to the fore. So when we see an undervalued market that has the potential for 15, 16, 17% returns, stuff your portfolio with passive and lower the cost. But when you're starting to transition out of that environment, then don't stay at the passive party too long, because it will ultimately come back to haunt you.
That's a good point. It kind of leads into my next question. So one of the things that Bob mentioned was kind of the bull run, and there's been some great performance. So passive has made a lot of sense. Because we're in a bull market and everything's going so well, has this kind of created an environment where you can continue to lower fees because everybody's still getting performance on the upside? And Michael, I would swing that kind of over to you first to answer. Has this bull market really been the catalyst to drive fees down because investors are still seeing returns because the market just continues to push higher?
I think it's probably a combination of two things. The first and probably the most important is it's just been a red hot market. Passive outperforms active typically, and most clients chase performance. They look in the rearview mirror to determine their forward-looking strategy. The second thing that I think it would be foolish to suggest isn't a part of this is the amazing technological revolutions in terms of robo-advisors and different ways to interact with clients and new planning tools and so forth. And also, the price competition among the giants. So you look at Schwab and they just keep cutting their fees, which forces Vanguard, which forces BlackRock. So there's sort of multi-layers in driving it, but I do think that you are putting your finger on what will end it. What will end this race to zero is when people see the value in active management. And that value comes to the fore when returns are no longer red hot. I think it's really important to remember that back in 2010, Barron's wrote an article about the end of passive investing because the S&P had just gone 10 years without making money. And that environment will come back because momentum-based market cap indices go through periods where they're the hottest thing on earth, and then they go through decades like the 2000s where anybody can beat them. So my bet is that we rotate back into that more 2000 to 2010 environment over the next few years, hopefully Xing out that 2008 experience.
Yeah, absolutely. And Bob, I would ask you to kind of throw in a couple quick points there. If there's anything either you agree with Michael or disagree that this kind of great market has helped propel returns and allowed people to reduce fees.
Well, I agree with Michael to some extent. One would have argued, logically, if I get you really good numbers and I'm able to, generate high returns, I could ask for a higher fee. The quid pro quo is that, but that if the market's beating you, even with high numbers, you're still going to have to justify why I have you at the table. And so, it's not just about the absolute returns. It's still a relative, performance issue. And I think that across the board, one could argue that, it's going to take some kind of a knockout punch or some devastation to the equity market, and all of a sudden active equity managers are going to rise to the fore. Well, that hasn't happened, and everybody keeps claiming it's going to happen, and I keep sitting there and I go back in history and I say, well, the numbers don't change very much. You go back to 2008, you go back to any other mini corrections, they don't really seem to show up very often and in great number. So, the argument, and it's not just me, people like Burton Malkiel, okay, and other noted economists and financial experts will tell you that, and I agree with Michael to a certain extent, that, being able to put passive strategies together with active strategies is the best synthesis in the world. How you do that and where you do that is really, really important. And I would argue that to be more passively inclined and sector allocated correctly and kind of adjust the big decisions in terms of international, domestic, what sectors am I overweight or underweight is the great thing to do on the equity side. Forget about the stock selection. But on the bond side, where people just say, oh, I'm just going to go and buy some big old BND or AGG and just let it ride, is the worst thing you could possibly do in the world right now. A, because most active bond managers generally do better than the market, according to the stats, short-term, long-term, intermediate term. But more importantly, when you look at the yield and the risk differential as expressed in duration right now in the ag index, it's the widest it's ever been in history. And right now, passive management and fixed income is probably the worst thing you could do in a broad general sense, but passive product that has smaller chunks of the market that are allocated differently than the way it is in the ag index, perhaps have a shorter maturity, shorter duration than the ag, overweight perhaps, MBS, and underweight high yield and other things that are in the broader index that don't change. That, to me, is where good active management makes sense in today's world, where you'll get paid off. And so active management has to be redefined. So what are you actively managing? Well, if you're not well paid to go down to the individual constituent level enough to justify 5 times the fee I would get in passive product, then don't do that kind of active management. Do the active management where fees and payoffs are actually in balance with each other, and perhaps even liquidity to a certain extent. I mean, the previous speaker was talking about tech and how there's a massive overweight in tech. Believe it or not, that tech overweight is expressed in all parts of the market, even in EM. 25% of the EM indexes, and I was just reading some work that was just put out by Franklin, and looking at the MSCI EM index, I had no idea, but I'm sitting here saying, oh my God, 25% of the EM index is now tech. And so,
and Bob, I want to stop you there real quick.
Yeah.
Hey, Bob, let me jump in there because there's a couple questions I want to get to that I know the audience has fired off to us. So
Sure.
This one, and you can take it to start, but it has to do with the low fees and what it's doing to competition. Michael said it before. You can't out BlackRock. You can't out Vanguard. Do you have concerns that at the end of the day, there's 5 providers that are out there, competition is done away with, and choice has gone away with, and investors are actually worse off because of this kind of race to zero? And then, Michael, I'll let you jump in, but Bob, if you could take about a minute on that, and then we'll turn it over to Michael because there's a couple other questions the audience has sent in.
Do we have a creeping monopoly going on in the delivery of financial services? I think there could be an argument for that. And I think everybody has a hand in that to a certain extent. It's not just the providers, it's also the buyers. So yeah, there is, to some degree, that is going on, and that's almost a self-fulfilling prophecy. But as I tell all the providers, I have a hand in this. I said, choruses always sound better than solos, and the market is made up as a chorus, and, solo acts generally don't last very long. And so what you need is to bring in as many constituents and participants in what you're doing and providing and creating. What is happening is that a provider has changed from purely providing you an ETF or a structured product. They have now gone into the business of, oh, not only that, we're going to show you how it fits into a broader themed model, and we're going to give you that model for nothing if you just load it up with all of our product. It seems to me that objectivity gets lost in that process, completely obliterated in terms of who's the best provider to provide what part of that model. You know, everybody likes zero fees, everybody. And I think that's the problem. And, you know, it's kind of like watching a snake devour its own tail and thinking that it's having a wonderful lunch. At some point, there will become a stark reality of, oh, my God, there's no more anybody to sell this stuff to. And so I put that warning out, and it's out there.
And Michael, I want to tweak the question a little bit for you, and you can kind of touch on the competition aspect. But should, on top of that, if fees continue to get lower, as a client, should I expect less from your services as well because fees are going down and all that kind of stuff? Can they still expect a high level of service from advisors, and should advisors still be expected to give a high level of service? So if you can kind of touch on those two things, the competition and level of service.
I think that is exactly the right question, because I'll go back to my statement. Fees are a concern in the absence of value. So if an advisor has a value-added package of services around the portfolio management process with, you know, wealth planning and estate planning and all the things that make much more than just the portfolio assembler, you know, I think those are absolutely essential value-add parts of every successful advisor's practice going forward. The day of the cowboy just running the money, that's probably moving into the background. The other thing, though, is, you know, you mentioned, you know, you can't out BlackRock, and that's absolutely true. And the scale that they have is just extraordinary. So we don't try. We just launched a series of ETFs about 24 months ago, and yesterday, ironically, they crossed the $1 billion mark. So it's been one of the most successful ETF launches of the last year or two. And you ask, what is it that makes these products successful? All right, there's a value proposition in terms of an actively managed component that people can understand. The fees are reasonable relative to competitive products. It adds incremental asset management services that are not typically found in other products, like currency hedging. That is an active currency hedge. It comes on, it comes off. And last but not least, and Bob mentioned this, we assembled it into portfolio solutions without charging an external fee. So financial advisors can tap into an actively managed process where there is an actual value proposition that they can articulate to their client. And that value proposition apparently resonates because it's been a very successful product launch, even as Vanguard, BlackRock, and so forth have been bringing products to the market that compete with it at zero external fees and 10 or 15 internal fees. So I think it is possible to compete with these giants, but you have to be where they're not, and you have to have a value proposition that they can't offer. And so that's the key to our strategy at Riverfront.
I agree with
that.
So we're doing the same. Go ahead.
Oh no, Bob, go ahead, because I was gonna wrap things up. So I'll give you.
I was just saying, I agree entirely with what Michael was saying. On our side, you know, one of the areas that we have launched is in ESG, and so sustainable investing and looking to the future. We have strategies and oriented kind of strategies in that direction. And we launched an ETF, you know, in the fixed income quadrant that is an ESG optimized product. But we see more growth and development kind of in that direction. So I would agree with Michael. You have to look for things that aren't very prevalent, and quite frankly, that's not very prevalent in the ETF lineup today. I think 5 years from now, that might be a different story.
Yeah, absolutely. It sounds like the industry is about to probably see a little bit of consolidation, whether that's on the provider side as far as the BlackRocks, the Vanguards. And I think Michael touched on it as well, right? You have to be able to offer clients a couple of different services now. So you could see some kind of consolidation within the advisory business as well. But For us, we are just out of time already. That half hour went very quickly, so I do want to wrap things up. Of course, a big thank you to Bob and Michael for joining us today, especially Michael, knowing that he's dealing with the flu to get on the phone with us today is greatly appreciated. Certainly want to thank Matt Dillon for taking the time to talk about the Victory shares, the Victory Capital funds that they have, and the different products that they're using out there. If you want to learn more about those products, it's www.vcm.com. Again, that's vcm.com. And I'd like to thank you, the audience, as well. We appreciate you taking the time out of your busy days to join us. And we'll see you again next week. For everybody here at Inside ETFs, thank you and have a great day.